Good evening and welcome to FINSHERPA's webinar. And we've been doing this webinar ever since COVID taught us that a lot of things can be done electronically as well. So we chosen to connect with our clients and our prospective clients through this means, and we have continued it through. And it's also a means of getting the best of experts. It's difficult to get people like Sunil, who travels widely and who's a very busy person, into a particular hall. Whereas on the means using Zoom, I think it's a little bit more easier, although we've been trying to get him for quite some time now. Uh, that said, a quick introduction. FinSherpa is into it's a mutual fund distribution house. We help people plan their money for both retirement, tax planning, estate planning. We do a variety of things relating to money, and that's what is the purpose of our existence. And we've been doing this webinar for quite some time. Like I said, ever since COVID time, we've been kind of engaging people for a variety of different topics and experts on this. And no better expert today than Sunil. Sunil is somebody I regard very deeply for his knowledge, his domain that he brings to the table, and he's a very, very respected person in the mutual fund industry as well. So I'm sure you're keenly looking forward to hearing his perspectives. But first, the context is always important. Over the last year, or maybe even slightly more than that, equity as an asset class has kind of not performed as well as we'd expect it to. So it's been very, very volatile, and rightly so, because interest rates globally have been going up, and there's a lot of uncertainty around financial institutions, especially the US, witnessed a couple of banks going down. So it's not the best of times for confidence, and times like these kind of test equity markets, and we've seen that play out over the last year. So globally, things haven't, the equity markets haven't been great, so to say. Uh, on debt side, the less we talk, the better. While interest rates have moved up, the average FD has tried to kind of keep pace. Debt mutual funds or debt investments per se haven't kind of kept pace. So it's all been low single digit unless somebody understands the space really well. It's not been a great time as well. But we are hopefully coming to the end of the interest rate hike cycles, which also I'm sure Sunil will touch upon these things. So in times like these, what should we be doing? Where should we be putting our money? What should be our thought process in terms of expecting what's going to happen next? These are all thoughts that many of us have in mind. I do have it. So when I'm in doubt, reach out. When the student is ready, as they say, the master appears. And so Sunil is here. He is the thing. A quick introduction about Sunil. Joined the Sundaram Mutual in 2005. So he has about 18 plus years with Sundaram, handled a variety of roles. Currently, he is the managing director. Sunil has, of course, had over 3 decades of experience in financial services, starting with State Bank, Amex, and Bank of America. And during his 14 plus years in Sundaram, the AUM of Sundaram Mutual Fund has seen manifold growth. But more than that, the few things that I admire of Sunil is his ability to connect data with the outcomes, and that's a fantastic way to understand. He makes even a layman understand what the outcomes are based on a set of data points. I watched him closely, and the passion that he brings to table is just amazing. If you have attended any of his talks earlier, you would know that the energy that he brings to play is quite extraordinary. So, with that words, I will not stand between you and Sunil. So, Sunil, as I promised, the floor is open. Maybe 35, 40 minutes for you to set the context. And then I'm sure we will have lots of questions to flow, and we wrap up in an hour's time.
Sure.
Yeah. With
Thank
that, I
you.
will
Thank
stop
you.
sharing and over to you, Sunil. Thank you so much for being here.
Thank you, Babu, and good evening to all of you. So basically, the topic, as you would have aware from what Babu sent across, is where to invest in volatile times. So the question, of course, before that is, should you at all invest in volatile times? Right? So from a fundamental perspective, like Babu mentioned, I like to use data a lot. And I think the first perspective to this is to understand volatility. Because only if you understand volatility, then you can decide whether A, to invest or not, and B, where to invest. Right? So I'm going to run a brief presentation over the next 30 minutes on my understanding of the volatility of the markets, and then to take you from there to some kind of a conclusion, and then we can have Q&A. So just give me a minute while I share screen. Like I said, this is what I've titled it. And so first of all, like even before the volatility aspect, I wanted to dwell on how does the stock market deliver returns to you. I think an understanding of this is absolutely base critical in before you get into this journey, right? And what I've done here is I've given you the approach to why stocks deliver returns. And I've highlighted in green those aspects, which green and in gray, which I'll briefly touch upon today. So basically, to the two greens there, tell you how the stock market gives you returns. The first is that the earnings growth expectation. So there's one thing I want to clarify. A lot of people look at the earnings growth and say earnings is not happening. The market is a futuristic player. The market doesn't care about the past. Please remember that. Right? So the historic ratios, whatever you see, are absolutely irrelevant as far as the market is concerned. The market is always giving you the future growth expectations in present terms. That's number one. Where do these earnings growth expectations come from? They obviously come from the overall economy. You have the world economy performing, then within that, the Indian economy, then within that, certain sectors do well, and then companies do well, right? And by choosing those companies is where those which get superior earning growth expectation will naturally deliver a better return. So that's the first fundamental, or if I may call, the fundamental aspect to investing. The second is the demand for stocks as it rises and falls. There are various names for this. They're known as valuations, they're known as P ratios. This delivers return. Why I wanted to highlight this is there have been times when the earnings growth expectations have been down, but the markets have been up. There have been the opposite, when earnings growth expectations are great, but the markets haven't delivered returns. Right? So if the first line were true, you'll say what's happening, and which is partly the answer to what's happening today. Right? And that's where the demand and supply. And why I say this is, just take a bottle of Bisleri, costs you what, 10 rupees, depending on, so 1 liter bottle. The same bottle of Bisleri in the Thar desert, you would pay 1,000 rupees to get that bottle of water. So the beauty lies in the eye of the beholder. So what do I mean by this valuation or the price to earnings ratio? That the E is what we refer to. The price you're willing to pay depends on what your return expectations are. So if you are an investor in the market, remember there are other investors in the market who are investing. And because they put in the money, the prices go up and you make a return. If they pull out the money, regardless of your own analysis, you will lose money because they don't have interest. So it's important to understand who is this demand for stocks coming from. And broadly, that's from two buckets, which I've highlighted in the last. There's either the foreign investors or there are domestic investors. So I'll briefly try to cover each of these three aspects. That's earning growth expectation, demand from foreigners, demand from domestic. So now if you move down, right, as I said, earnings growth expectations comes from the economy. And since we are in India and the Indian economy, this gives you the Indian Economic Survey data. I like this slide because it's in one snapshot. It gives you everything you need to know about the economy, right? I know it's a bit dated because it's one day before the budget, but since the budget, I can tell you, I'll show you a few slides. Nothing has changed. If anything, it's only improved for the better. So the center is the GDP growth. As you can see, post a COVID drop, the economy has risen to high single-digit GDP growths. This has been accompanied by a diminishing fiscal deficit. Any deficit going down is good, whether you understand fiscal deficit or not. Just the fact that a deficit goes down means it's good. Inflation spiking during the post-COVID phase, both wholesale price and consumer price index have stabilized. And then you look at the components of the economy, that are there, the Indian economy has three primary sectors, right? Services, industry, and agriculture. As you can see in all of them, there has been a steady revival post-COVID, high single-digit growth in services, high single-digit growth in industrial growth, tapering to 4%. And agriculture, because of good monsoons, has remained at a decent single-digit lows. Agriculture is never going to be a double-digit growth factor, right? And finally, the last one on the left is the foreign exchange reserves. Why is this important? Because the currency, right? Just like a stock price tells you the price of a company, whether the price equals to value or not is a debate, but it tells you your net worth tells you your worth in the country. A foreign exchange price, that is the currency price, relative to other countries tells you how good is our country. And so the reserves are the one that enable the country to defend our currency so that it reflects the true value of our country. So the more the reserves, the more the power the Reserve Bank has to prevent unnatural events from coming and hurting the perception of our country. So I think the size of the reserve has value in that. So with that, you can now understand that in the Indian economy is on a good, decent wicket. Right now, to take that forward in terms of specifics, because that was, like I said, a bit dated, look at these graphs starting from COVID, right? And a whole range of indicators, which we call high frequency indicators, which tells you what's happening in the economy. So you have power, you have e-way bills, the way government buys, you have exports, you have two-wheeler sales, you have GST collections, rail freight, vehicle registrations, and passenger vehicle sales. All of them, after dropping during the COVID phase 1 and phase 2, have seen a secular rise. Some are V-shaped recovery, some are U-shaped recovery, but they are all rising. So it gives you a good sense of the health of the economy. The next is credit offtake. Why? Because why would people borrow? Interest costs money. They borrow only when they see your future is good. You want to buy a house because you believe you should upgrade. Company invests in a factory because they believe the future demand is good. So credit growth, whether it's industry credit, services credit, non-food credit, all of them are rising, which tells you that overall retail and industrial consumers are feeling the future is good. So I like to borrow to invest in my future. So a very good indicator of the future. These PMI, this Purchase Manager Index, both for manufacturing and serving, is trading above 50 and is rising. PMI briefly is nothing but an opinion poll of purchase managers of the large companies in India. Ask them, are you going to buy more this quarter compared to last quarter? When they say yes, it means their order book is rising. That's why they are buying raw material. So this gives you a clue as to future GDP growth. So this graph now takes you from the present to the immediate future to tell you that if it's above 50, more than 50% of the people are saying that I'm buying more this quarter, which means my order book is better. So a good indicator of the coming months GDP growth, which is a very similar thing which Morgan Stanley, as an analyst, prepares something called a domestic activity tracker. And as you can see from the past, this activity tracker predicts the GDP movement very accurately. When the blue line is going down, the coming months, the GVA goes down. When the blue line is going up, the GVA goes up. Now, what is the recent trend of the line telling you? That GVA is poised to strongly grow in the coming months. So with that, I hope I've given you a sense that the Indian economy is indeed on a good wicket in terms of its overall. And drawing from the economy to the earnings. I've taken this data since October 2021 because that was the previous market peak. So those who have been continuously investing will know. And if you see here, out of 322 companies surveyed, 107 have shown a 30% plus revision upwards in their earnings. Another 78 has shown a between 10 to 30%, and overall Nifty has shown a 24%. So if 185 companies are showing you a positive earnings trajectory, it means that that economic performance is indeed reflecting in corporate performance. But the broad stock market returns have been volatile. If the economy is good, earnings are good. Yes, 1 month there is positive, but 3 months is all negative. And in some of the indices, 6 months and 1 year also are negative. So in a good story, why is the market? That's the answer. If earnings have been good, why has the stock market been volatile? The answer lies in this, back to slide 1, where I say that's the demand for stocks which has caused this volatility. Now, what is this? Because you see from that October, September, earnings growth versus price. What am I showing you here? 82% of the companies have seen their PE ratios come down despite their earnings going up. right? So why is the market not respecting that earnings growth? That's the $1 million question, right? And this graph gives that very clearly to you. On the x-axis, you have the EPS upgrade downgrade since then, right? Consensus estimates going up. On the y-axis, you have the P expansion contraction. So as you can see from those dots, right? A whole bunch of dots are on the right, but because of the downgrade is where the price correction has happened, right? So let's now understand this from what this has meant to our valuations. So if you take just the Nifty, for example, this is the Nifty 1 year forward P ratio. That's the valuation. Now, what is valuation? The price you're willing to pay for your goods. The goods in this case are earnings. What has happened here? The red line in the middle gives you the long-term average P ratio of the Nifty. The blue line tracks the actual PE ratios 1 year forwards as they moved. And there's one standard deviation down and one, I'm not going to get into the technicality, but as you can see from the numbers, in October 21, the Nifty was trading at a 23 PE. If you can just take between April 21 to 22, see how that blue line picks up. So the forward PE was 23 in October 21. It was 25 in April 2018. Today, it's trading at 15 PE. And our long-term average is 19, as you can see from the red line. So this correction has meant that our market today is extremely cheap. Right? So why? Because earnings have been growing up, but prices have come down. Right? What is the reason for this? The answer to this lies in who owns the stock market and who buys and sells. They are two very different things, these two lines. So if you can now pause and look at this slide, I draw your attention to the left-hand side to the pie chart. That is, who owns the stock market, right? What does it tell you? In the green part of the pie tells you that 45.13% of the market is owned by private promoters of the companies, which is Azim Premji owning Wipro, for example. Why that is important? That's like almost half the market is owned by these people. But what is the key about them? They never trade in their stock. They are owners. They are the guys who have started these companies are owning them. They will dilute if they need capital, but they don't go and trade in their stock. So they do not cause volatility in the market because they are consistently there. If anything, they may buy a little more if they have confidence in their company, but they are not going to sell, right? So then who buys and sells? It's the rest of the people. Now the non-promoter holding, which is 100 minus 45, that is 54.9%. That's called the free float market cap. Free float means available for sale. The trading, the buying and selling in the free float causes the volatility in the market. Now, what is the composition of the holding of that free float? Is what I've given in the Excel table on your right. As you can see, FIIs own 37% of the free float of the country's stock market. They are the single largest behemoth there who are determining our fates. The rest of the holding is roughly equally split between 14% with domestic mutual funds, DMF is domestic mutual funds, 17% with millions of individual retail investors, and 16% with the insurance companies, LIC plus other insurers. Right. Now, what is the key aspect of these domestic is, please remember that I'm going to make a slightly controversial statement, and it might, say, Babu will say, why are you saying this? What I'm saying is a fund manager, whether of an insurance company or of a mutual fund, has absolutely no say on whether he comes to office one day and buys or sells stocks. He'll say, hey, what's the point in giving the money to the fund manager if he has no control? Why? Because he can only buy if he has money, dear friends. It's only if you investors, through Babu, give money to the mutual fund that we have to buy. And if you redeem the money, we have to sell. And when the economy is down, you give me money, I will still buy. When the economy is up, if you pull out money, I have to sell. Though my personal inclination with a good outlook of the economy is to buy, if you investors pull out money, I have no choice but to sell. So why I'm saying this, none of these fund managers are determining the volatility of the market as a whole. Where does the fund manager have a say? On whether he buys a large cap, a mid cap, or a small cap, whether he buys a banking stock, an IT stock, or a pharma stock, whether he sells a banking stock or consumption. So within the market, The segments of the market is all the fund manager has the ability to decide. The reason I'm stressing on this point is that fund managers are not the cause of volatility. Yes, they may buy a mid cap instead of a large cap to that say inter-say volatility may come. But overall market volatility is not in the hands of fund managers. And who is it in the hands of? Millions of investors who are either directly investing or giving money to mutual funds or giving money to insurance companies. We cannot predict the behavior of millions of investors, but we can see what they've done in the past. Then the answer lies, then who's causing the volatility? It is the FII. Right? Now, what about the FIIs? Is all this 37% of FIIs one single monolithic George Bush or a Trump who sits there and decides? No. The total FII holding in India is $600 billion. The breakup of the FII holding is on the left-hand side, the red part of the pie chart. Sovereign wealth funds own 16%, pension and insurance funds own 8%, and mutual funds and hedge funds own 68%. Now, here again, the sovereign wealth funds and the pension and insurance funds are long-term investors who are investing in a growth market so that they can raise the necessary alpha, the additional earnings to pay the pension liability that they have to honor in 10 years or 15 years. So they are long-term investors. So it is the MFHF pack, which though it owns 68% only, accounted for 75% of the outflows that we saw since September 21. So now within MFs, obviously, and HFs, there are three partitions here. So there's an active mutual fund, which is what Sundaram Mutual Fund does. Then there's a passive mutual fund, which is an index fund or an ETF, right? And then there's a hedge fund, which is a highly speculative, taking anywhere between 1 day, 1 month, 3 months, 6 months, 1 year call on the market, right? So the active, so what does the passive and active, would they do? 1 minute, sorry. So typically, like in India, when a large cap fund manager has a Sensex as a benchmark, the mid cap fund manager has a mid cap index as a benchmark, a foreign investor, when he is investing in India, is part of an emerging market pool. So this, what I've shown here, is the breakup of the emerging market index of MSCI. Right? So anybody who gives money, a foreign investor who gives money into an emerging market fund, that pie chart tells you that 15% of that comes to India, 31% of that goes to China, and the rest is spread across the rest of emerging markets. Right? So again, the passive funds we cannot predict their actions because these are millions of investors spread all over the world who are just putting their money in a passive fund. And that passively puts in. So if investors across the world believe in India, they give money more to, they don't choose India, they choose emerging markets. So 15 rupees of that. So then they are also not somebody we can understand and predict and react to. So who is left? The active mutual fund and the hedge fund. Now, what does an active mutual fund do? He has a benchmark of the emerging market index, and he may say 15% is the benchmark weight. I am overweight on India. I'll give 20 to India. Or he may say I'm underweight on India. Instead of 15, I'll take only 10 on India. So through his brains and his analysis of India versus other countries, he chooses more or less than this, which is called overweight, underweight, and they decide. So it's important to understand when will mutual funds overweight India, when will mutual fund managers outside India underweight India, number one. What about the hedge funds? They are super mutual funds. Why? Because mutual funds have a 3 to 5 year time frame even abroad, because they are long-term wealth creation tools. But a hedge fund is a short-term margin trader. So what he does is he collects money from investors. Let's say he collects 20 rupees. He borrows 4 times that from a bank to borrow 80 and make it 100. He pledges that entire 100 investment with the bank as security, and then he invests in a market. So when he then invests in the market, if he makes a 1% return on the overall pool, he's making a 4% return on his money. Whereas he makes a 1% loss, he makes a huge loss on his money. So he's very sensitive. And what is he sensitive to? The first thing is most of this money comes from the advanced economies. Right? So the advanced economies, they are historically, leave this recent Russia-Ukraine war-related spike in inflation. Advanced economies are generally demand-driven. They are generally low inflation, low interest rate compared to emerging like India. So when the rule of currency tells you that the low inflation country, which is also the low interest rate country, when it's compared with the high inflation, high interest rate country, its currency must appreciate by the difference in the interest rates. So if you say US is currently at 3.5% or 10-year yield, India is at 7.5%. That 4% difference means Indian currency has to weaken by 4% every year based on fundamental analysis. Obviously, short-term flows like the stock market, currency is also a commodity, so that varies. So why I'm saying this, when a hedge fund puts money into an emerging country, he expects a 4% loss from a country like India due to currency. And the return from our country must compensate for that currency loss and deliver the return. So only if India gives a 7% return, he'll make net 3. But the net 3 will translate into 14% for him because of the fact that he's only put in 20% of his money. Right? So the hedge funds are very sensitive. The reason I'm spending so much time on it, because that's where the answer lies. Otherwise, I wouldn't spend so much time explaining this hedge fund, mutual fund to you. Right? So thank you for bearing with me on that fairly detailed explanation. And now I come to whether what I'm saying is true and so what. So what I want to say is, I want to, for a minute, go back here, is that within the emerging market, India is a very peculiar country. Now, when I say peculiar, what do I mean? I mean that the allocation to India, though it's 15% here, active managers like mutual funds, hedge funds, take very strong calls on India compared to other emerging countries. What is the reason? When I say this is, India is actually a contra bet to the rest of the emerging market. Why do I say that? Is that barring China, right? Most of the other emerging countries are commodity exporters, whereas India is a commodity importer. So this is a very key factor for which, I'm sorry, I went the other way, right? India imports 83% of its oil, and we are an economy growing at 6 to 7% per annum, right? So our oil consumption is going up and up. So the oil price movement has a huge impact on India as a country, as a stock market, and on individual companies. I've listed out 8 factors which get affected by an oil price rise. I've written them in red because it's a rise is a negative for India. I would write them in green if oil price is falling. Okay, so this, according to me, is the single biggest factor which decides the allocation of active mutual funds and hedge funds into India, right? Which means that if oil price is rising, they get panicky about all these things that will happen, including within that is the currency depreciation, which will be much more than 4%. It may be 5 or 6 and enhancing his loss. But the very opposite will be true if oil prices are declining. Now you can say, this all is very good in theory. Is it practically, this is what has happened? So I draw your attention to this graph. So here on the table above, I've given since COVID, every quarter FII flows or outflows into our country. Green represents inflows, red represent outflows. In the bottom, I've given a chart of the crude oil prices. So can you see there very clearly that post-COVID, India got a huge amount of money. Why? Because oil prices had crashed to as low as $20. I've drawn an arrow. When oil prices started rising in October, November, December of 2021, you can see FIS pulled out the money. And if you just roughly total it, you will realize that 2.8 lakh crores came in that first 6 quarters, and 2.5 lakh crores of that 2.8 out went out in just 3 quarters. So can you see the high degree of sensitivity? And then in October 22, in June, July 22, when the Fed recognized that there was an inflation problem, started hiking interest rates. So the world felt, oh, they're going to slow down the growth. So oil started correcting from 125 to 85. FIS came back into our country in the next 2 quarters. Now, in the last quarter, there's a small oil spike, but that outflow by FIS is not related to oil. I shall explain that to you later. But over a trend of time, you can see that these active hedge funds and mutual funds pull and push money out of Indian market very, very closely linked to the oil price movement. And that is the main answer to why our markets have been volatile. So now when you move into this, you can see that I want to first tell you some source of comfort. You are all worried about the volatility in Indian markets. But this graph tells you that the volatility that we have suffered is far less than the volatility that the global stock markets have suffered. So, you might be feeling, oh God, why so much volatility? Imagine yourself compared to the rest of the world. Why is it that despite our perception of high volatility, the volatility is less? What is the reason? Because of the fact that while the FIIs have been selling, domestic mutual funds and insurance companies have been consistent buyers. So now you see in the same table, I've added MF activity there. You can see in the first few months of COVID, Indian investors pulled out money from mutual funds, hence mutual funds sold. Why? Because you panicked about the lockdown, panicked about the fact that factories were shut, that you couldn't go out and spend. You perceived that the economy would go bad, and so you pulled out money. But the FIs were putting in money because oil price had crashed. And then in April of 2021, mutual fund investors came back. Why? First, a feeling of having been missed out because the markets had since doubled and you had pulled out your money. So, typical reaction to that, you came back. Second was there was a V-shaped recovery happening post-COVID, so the news was looking good on India. So, but the good point is, since then, consistently, except for this one October, November, December quarter, mutual funds have been consistent buyers because investors have been consistently giving money. And then on top of it, in the graph I've shown you, 89,783 crores. In addition to this, insurance companies have been buyers. So people have also been giving money to insurers. So close to almost 3 lakh crores of buying what has made our market not as volatile and not fall as much as other stock markets across the world. So there is some crumbs of comfort there that the volatility that you have suffered is not as high as the rest of the world. Okay. So now, right, if you now then look at it, right, I'm showing you this, the premium that India enjoys. Why I'm saying this is because we need to look at India from a foreigner's eyes, right? I made that very clear, right? So the selling, so if you see this line, again, the red line in the middle tells you the average premium that Indian stock market has been to the emerging stock market. So which means what? Right now we are at a 9% premium. Can you see that red line? It's 9. But some months back, it was at 11.5, almost hitting 12. Right? So this selling which took place because of the oil price rise has brought down our premium. Why I'm saying this? To a foreigner, compared to a few months ago, India is much cheaper today. Right? From a perspective, right? That's one. The premiums have corrected significantly. Next. India's weight in the global market cap as a result of this FI selling has also dropped significantly. It's still above the median, which is 2.7% of the world stock market, India's investment, but it has fallen down significantly. So why I'm saying this, just compared to a few months ago, the amount FIIs had invested in India's market and the market cap, today it's much lesser. So valuations are not going to be a concern for that hedge fund or mutual fund to come back into India. That's the point, right? Next. So now obviously the future market behavior depends on these FII flows. So for that, since we are talking, we need to look at the world economy. Why? Flows into India are going to be determined by the situation of the world economy. We can't ignore the world economy. So this gives you a snapshot of the latest IMF World Economic Outlook. So the left-hand green tells you that world economy last year grew at 3.4%. This year is expected at 2.8 and next year at 3. United States, as you can see, the red is a continuous decline. Europe, after dropping for this 23, next year is going to show small recovery. But as you can see, the shining light is emerging and developing Asia, which on an average is going to go at 5. Why I'm saying this is that, so clearly there's a polarization in growth between the advanced economies, which are slowing down, and the emerging economies, which are going up. Number one. Number two is that recession gauges tell you that the Europe looking like they're coming back out, but the US still got a high risk of recession. This is very, very important to understand. And this is borne out by another stress indicator on bank lending. The hike in interest rates has led to people defaulting, delaying their credit card payments and all that. So the systemic risk in the US is inching up. And there is something that the conference board in the US arrives at as an indicator using 10 indicators. They aggregate them into an index. And history tells us that last 40 years, every time this indicator drops below 0 and stays there for 2+ months, we get into a recession. This now has gone below 7%. So why I'm saying this is, despite all the news, the fact is that the US is heading towards a recession, right? What is the implication of that? The implication of that is that the US had to hike interest rates to control inflation. That's paying off, but that's led to the other problem of bringing on a recession. So headline CPI inflation and core CPI both have started easing. And the Fed, which was constraining liquidity from $8.9 trillion, they had brought it to 8.3. Because of the recent banking crisis, they have again started pumping liquidity. So why I'm saying this is, if an FII has to invest in India, the hedge fund, there must be liquidity available to borrow. So the Fed, from a crunching liquidity, QT, has now gone back to releasing liquidity, which is QE. So plenty of money is available in the world to invest in India if they so choose. Now, what has happened because of this is that the green line, the dollar versus the other countries, dollar has started weakening. Why this is critical is when the US hikes interest rates, world markets tend to invest in the US because they see that a higher return on their investment in a US treasury. So that demand for money makes the dollar strengthen. When people feel that the US is going to cut interest rates, the dollar weakens. So what this is telling you is that the market is has already weakened the dollar because they're expecting a rate cut in the US. Right? So because the commentary of the Fed said that I see a rate cut from next year, but the markets are saying this rate cut is going to happen in this year itself. So this over the last month has led to a sharp pickup across the world in 1 month equity returns. Can you see just that direct correlation? Why? Because US dollar weakness leads to flows into risk assets such as equities and emerging markets. So you can clearly see here that on a 1 month basis, whether it's the Dow Jones, NASDAQ, or the MSCI, emerging market, China, India, Hong Kong, everything has bounced up, right? Because the market is expecting cheap money and easy liquidity. Hence, these assets have started rising, right? So in that scenario for India, right, yes, we have also seen a 2.4, but it's not been as great as the bounce back in others. In fact, for us, 3 months, 6 months, and 1 year are still negative. So to reinforce that point, you can look at the Bloomberg's emerging market capital flow proxy, which tells you that money into emerging markets has started flowing back in again, which is good news for India, because within the emerging market, as you know, passive fund would allocate 15% to India. Now, what about our market? This gives you a summary of that slide that I showed you earlier of the quarter on quarter. And I would draw your attention to the last column, right? As I told you, there's been 26,000 crores of outflow in Jan to March, though oil prices have been stable, right? Oil prices haven't really moved anywhere in the last quarter. But still, despite that, the 26,000 crores outflow. What is the reason? I've given there in the heading there. It is the Adani factor and the banking crisis, Silicon Valley Bank and Credit Suisse, which made FIS panic on taking risk and panic on banking sector in countries around the world. They felt there would be a spillover effect. But the very next, from April onwards, you're seeing the FIs are back with a bang. Already April to now, 20 days, they brought in 9,600 crores of money, right? Now, what's the potential? What am I driving at? I'm saying that post-COVID, if you see the first table on the left-hand side, 282,000 crores of money FIs put into India when the oil price was declining. When the oil price rose in that October to June 21-22, out of the 2.6 lakh crores they pulled out, right? Leaving a net 26,000 crore net investment by those people. And then 95,000 crores they pumped in back. Now, if you see the center table, that means net from the money, the 2.8 lakh crores, 1.86 lakhs crores is yet to come back to India. So the potential, 9,600 of that has come in April. So there's still 1.76 lakh crore of FII money, which was in India in the post-COVID phase, which is waiting for what? For declining oil prices, right? So, and the domestic investors have been consistent buyers. So if you see there, the cumulative domestic mutual fund FI outflow has been 2.85 lakh crores in the same period, right? So the net 98,000 crores positive. And as you are aware, significant proportion of the domestic flows are through the SIP book. And every month you're only seeing that SIP book rise. So in the immediate future, I don't see a threat to domestic flows not supporting the market. So I think with them supporting the market, if this FII money comes back, I believe the previous highs are nothing. Because remember, the previous highs were reached when domestic MFs were sellers at COVID time, right? Post. So now that domestic is buying, the market hasn't actually fallen as much as the FI selling should have. So when on top of it, that same amount of money comes back, sky will be the limit for the market when it goes up, right? So when will this oil price? What is the story? But beyond that, I also wanted to show you in that table, India was not specifically there in the world growth. As you can see here, despite the fact that IMF has revised down our growth by about 20 basis points for this year and about 50 basis points. We still remain the fastest growing country in the world, both in 2023 and in 2024. So growth will not be a concern for an FI to look at investment in India. So the fundamental EPS growth will not be a challenge. So then oil is the key. And what's the story behind oil? As I said, it hasn't gone somewhere. But the story behind oil is very simple, right? The world oil demand is 100 million barrels per day. I've circled it. Of this 100 million barrels per day, 70 million barrels is supplied by non-OPEC countries for whom oil they have to sell to survive for their economic growth to be. So they blindly will supply that 68 to 70 million barrels. There's a shortfall of 30 million barrels for the world demand. And this is where that cartel called OPEC, led by Saudi Arabia, plays tricks. They supply only 27, 28, 26, create an artificial shortage so that the oil price doesn't drop. They have the capacity to pump 50 million barrels, but they supply only less than the demand so that there's always a gap and the price doesn't fall. Right? When the price fell, why did it fall? Because at that time, the world demand had collapsed in post-COVID. So what is the take on oil? Why is the oil still firm? It went from 125 to 80. Why it's still firm? Because two things happened. Mr. Biden announced what I consider, and this is being recorded, so I'll use softer language, considered something as a very wrong decision. He announced a price cap of $60 to $65 on Russian oil. Okay? What was wrong with that? First, that he announced the price cap when the winter was starting in the Western world, when demand will be at its highest, because heating is a key energy requirement in the Western world. People die within their homes if there's no central heating in their homes. Okay? He announced it, but Mr. Putin proved smarter than Mr. Biden. Because what he did, he said, any country which accepts the price cap, I shut my gas supply to you. So entire Europe, in the time of winter, was suddenly seeing the stark prospect of not having energy to heat their homes. They went with the begging bowl to Saudi Arabia, and Saudi Arabia said, I will supply, but on my terms. That's $80 per barrel. Take it or leave it. So naturally, world oil prices stuck at $80 because of that. Now, what is the way forward then? So if you now see, right, all we need, if you look at to 2020, when prices crashed to that $20 levels, right? What had happened? Oil demand had collapsed only to 91 million barrels. Just a 10% correction in world oil demand meant that Saudi Arabia couldn't drop below 25 because they need that much pumping of oil to keep their economy going, which is a freebie economy. From birth to death, every Saudi Arabian or UAE citizen, everything is paid for by the government. So they've also, their economy has built to such a level where they can't say, I will produce only 19. No, 25 is a Lakshman Rekha. So what happens? 91 minus 25, there was surplus oil. So instead of a 1.7 million barrel short, it's over 2.7 million surplus. So naturally, oil price crashed. So when will this happen? This will happen when winter turns into summer. You'll automatically see that the heating requirement will drop off. Second, if US is going to go through a recession and the world is going through a slowdown, naturally, oil and energy consumption will be trending down. So I believe that over the next 6 months, we are going to be in a position to see a declining oil trend, which is what a hedge fund and an active mutual fund is waiting to reallocate the money within the emerging market, where the weak dollar, the low interest rate on the dollar, and the liquidity being pumped by the Fed will combine to give emerging market flows. But India's allocation within the emerging market will be critically dependent on the trajectory of the oil price, which I believe in the coming summer is going to be an easing trend. right? So with that in mind, let me now focus quickly onto your investment. So we talked about the large cap valuations being at 15 and well below. What about mid and small, right? There in this table, though it's a complicated table at the top, just look at the bottom. I've compared three levels, right? December 2017 was a market peak. March 20 was a market low. October 21 was a market peak and current levels. What can you see there is that in December 2017, the mid cap index was trading at a 35% premium to the large cap index, and the small cap index was trading at 11.7% premium. Today, the mid cap index is trading at 11% discount and the small cap at a 7% discount to the large cap. So if the large cap itself is lower valued, mid and small caps are even lower in terms of their valuations. And if you see the history of the Indian stock market, when the economy goes through good cycles and bad cycles, the top gives you the vicious cycles and the bottom gives you the virtuous cycles. The periods are given there. When did we have vicious cycles, virtuous? But the summary of it is, when you're in a bad economic cycle, small caps lose most money, mid caps lose slightly lesser, large caps sometimes protect, sometimes lose lesser. But when the economy is in a virtuous cycle, the exact opposite takes place. Your large caps deliver X return, the mid caps deliver X plus Y%, and the small cap delivers X plus Y plus Z% consistently. Given that the Indian economy is on a good wicket with a lot of recovery, I'll not bore you with any slides on that, but it is on a good wicket. I believe that over a period of this cycle, you're going to see mid and small caps probably outperform large caps in terms of the thing. But doesn't mean you put all your money into mid and small cap funds. Where do you invest? What do we invest is, these are the key things. First, keep a domestic orientation. Why? Because the world is going through a slowdown. External oriented stocks are not going to be doing the best earnings growth, right? So keep your focus domestic. Second, broader cap curve. What do you mean by broad? Across large, mid, and small. You'll say, you just made a case for mid and small. Why are you recommending large? Simply because if 1.75 lakh crore of FI money is waiting the sidelines to come back, where is it going to come? It's going to come into large caps and larger mid caps, right? So while the long-term economic growth story will support a mid and small cap revival, your immediate large cap will benefit from the flow from the thing, right? So that's the key. So from that point of view, right, allocation by you should be based on your risk appetite. Okay, it can't say one rule fits all. So if you're aggressive in your orientation, I would say that today a mix roughly, I'll leave the final answers for you all to Babu. He's your friend, philosopher, guide, and advisor. But broadly, I would say today giving a 50% to large cap, and then in a year, segueing it into 30% of large cap and increasing your mid and small cap is a sensible strategy if you're doing the allocations separated to large cap, mid cap, small cap. However, if you're a bit moderate in your risk reward, then there are industry funds which do this allocation on your behalf and take away that taxation call, because 1 year short-term capital gains, more than 1 year long-term, in these funds, you don't need to worry. But within that, just a sense to me that if you ask me, over a 5-year plus kind of a time frame, I would expect the multi-cap category to beat the flexi-cap category, with large and mid-cap being in the middle. The reason for that is the SEBI regulation, which makes a minimum of 25 to mid-cap and small-cap in the multi-cap, means that you're not at the mercy of the fund manager's call on when to shift the portfolio, but he's consistently going to be at least 50% in mid and small caps. So to that extent, you will catch the upswing earlier than a flexi cap where the fund manager has to take that call. The second is in flexi cap funds, most of them are benchmarked to a BSE 500 or NSE 500 index. Those indices have 80% large cap. So it requires severe guts from a fund manager where the index is 80% to say, I'll go to 30%, which is my recommended next year. So some fund managers will do that. I'm not saying they will not do, but it is a risk. Whereas with a multi-cap, you're already in that boat, sailing on the mid-cap river and the small-cap river. You don't need to jump boats, right? So to that extent, depending on your risk appetite, you can choose, again, safer is flexi-cap, in the middle is large and mid-cap, aggressive riskier is multi-cap. But to the third aspect, right, you're very conservative. You're worried about the loss, the volatility and everything. Then the hybrid funds, right, and debt funds give you that protection, right? And aggressive hybrid has the highest 65-70% in equity. Balance advantage is like a flexi cap, whether it can go up and down. But equity savings is the closest to a debt fund. And the reason I point out this is that there is a sector called arbitrage, which gets equity taxation but gives debt-like returns. So equity savings funds have about a third of their portfolio in this arbitrage. So they give you much less volatility than an equity fund, but they'll give you over a longer period of time much better tax advantage returns because they have got equity taxation. So the recent tax rule that happened with the finance minister throwing a googly at us suddenly, right, which led to a lot of angst over the debt, I would say that yes, one option is to go into the fixed deposits where there is absolutely no risk from a bank, but you're giving up a lot of return. But putting in debt funds, Babu and his team can advise you on the duration call, on the credit call. But equity savings to me is the closest within the equity basket where you get an equity taxation. So the like-to-like return is much better because of the equity taxation. So yes, but there is equity risk. Please do not think that it is risk-free. There is equity risk. So to that extent, I would say that you can consider it. Suppose you say that I want to allocate money into equities over a period of time. Generally, you use something called an STP. You park money into a liquid fund or an ultra short term and then switch it into equity because you're worried about the volatility. You want to take advantage of the volatility in putting money. I would say that equity savings is a good option for using it as the vehicle through which you do the STP for the simple reason that the taxation for your first set of installments is only 15% short-term capital gains tax, whereas in debt, it is your marginal rate of taxation, right? And once you cross a year, what happens? Your first 1 lakh rupees of tax is exempt in long-term equity, plus your taxation is only 10%. So it's a much more tax-efficient vehicle even to segue into equity by coming in initially. Yes, there is more volatility than debt. It is not fair of me to end this without telling you that definitely it is more volatile than debt, but at the same time, it's a risk worth taking, in my opinion. Right? With that, I will conclude my short speech. I hope, Babu, I have not taken up. I have indeed taken up a lot more time, I think. It's
Absolutely not. Absolutely
but
not. Thank you, Sunil. Always, like I mentioned at the start, always a pleasure to listen to data-driven approach that Sunil brings. In fact, I'm sure you would have had a bag full of lot more data points because the time is short. I know that you would have had a struggle to carry down time. Thank you, Sunil, so much. So please, kind of share your questions either on the chat window or you can kind of unmute and ask. We have some time for questions. Sunil, 10 minutes more, is that fair? Would you have?
even 15 minutes is fine.
Great, great. So we have Sunil for some more time. Sunil, I know that your heart lies in equity and you're an equity man. But just for a moment, step back and give us a view of what you would say if somebody, as per their aspiration, need to have some money in debt. You did mention about the equity savings fund, but if you were to look away from that alone, equity and commodities like gold and silver, what would be your thoughts? Where are they going to be headed? Tomorrow is Akshaya Tritiya, so gold. Either are we going to see higher gold prices going up in the near future, or have we seen all that gold has to do?
So let me take a couple of minutes to explain this. So India is the largest buyer of gold in the world, right? Even Switzerland is slightly higher than India, but that's gold headed to India via Switzerland. Okay. But we've been that way for decades now. So just like the ownership of the stock market, our ownership of the gold stock is the highest, probably. But we don't decide gold prices, despite us being the largest buyers, because of the fact that the sovereign wealth funds, right, have become very active players in gold. And today, gold prices react to the dollar. So historically, gold has been a hedge against inflation, hedge against the war, and hedge against that. But on top of it, what has happened is that the gold is a contra to the dollar, is the way it has behaved ever since even COVID, I would say, right? So what is the source story there? A country like China, which has $3 trillion of forex reserves, right? Or Norway. What they do is when deploying their sovereign wealth, right, in outside of this, they say that if the US interest rates are rising, they get a double whammy because they put money into US dollar government securities. And because of that, the currency strengthens. So their own action creates a positive alpha, but they get a 3 to 4% return. also on that money, because gold doesn't offer that return. However, when dollar weakens, then by putting their money in a weakening scenario, they're going to say mark-to-market capital erosion of their capital, and they're going to get lesser yield because the interest rates are falling. Then they switch to gold, right? Now, given that scenario, the recent move of the dollar to weaken has already caused gold to rise sharply because the markets are future forward looking, right? So gold has already erased all the losses it saw in the interest rate hike. And now up to 3 years, gold returns are positive and very good. But given that the scenario is one of a US recession and of a declining interest rate scenario, I would say that gold has still some more rally to go. So I would say that gold is a very good hedge against the dollar's weakening, and you should allocate 5 to 10% of your portfolio to gold, right? And there again another thing, again Nirmala madam has made gold ETFs as a taxation inefficient vehicle. So another way to play that is the multi-asset funds, which carry some amount of gold in it. But then you're carrying equity risk and debt risk and this. So take that in mind. So how you buy your gold, is that. But yes, I would say an allocation to gold, I would say gold should be rising in a weakening dollar scenario. Right, that's one of the commodity. On the debt itself, while I mentioned equity savings, right, if there is somebody who really understands debt, who's comfortable with debt, right, I think it's a good time to go long bond, because when you are talking about a declining interest rate scenario in the US, India has to follow, otherwise the implications come on the currency. So in India, the RBI's interest rate policy has nothing to do with inflation. Again, a second controversial statement I'm making here. Why do I say that? Because India is a supply side economy. Food accounts for a major portion, oil accounts for another significant portion. 60% of our CPI comes from supply side effects. Interest rates can't have much impact on supply. Interest rates can have an effect only on demand. But the US is a demand-led economy. So interest rates have an impact. So why I'm saying this is, then RBI's interest rate hikes have all been to protect the rupee. Because while the US hikes interest rates, if RBI doesn't hike, the gap widens and the rupee will weaken, thereby hurting our imports, and 83% of our oil is imported. So because of that, when the US then cuts, we also have to cut to keep pace, because otherwise the currency will hurt exporters if you strengthen it. So a balance is always achieved. So in a declining US interest rate scenario, I would say India also, you can expect a stable to declining interest rate scenario. So if you're long bond, then you will have a good chance of capturing the mark-to-market gains, right? The taxation impact obviously has been taken away. So it's a more nuance to call today. But yes, on taking credit, see, if you have a 3-year, so maybe even 5-year perspective, I would say it's not a bad time to take credit, because Indian economy is in that borrowing cycle increasing now. So you will see that already you see that the credit growth rate is higher than the deposit growth rate. So while banks will benefit from a wider net interest margin, corporates have to pay more and more interest rates there. So point is that credit funds can give you good returns. Alternate interest funds, alternates with real estate also will give you good returns. But be clear to get in and get out in about 3 to 5 years, because then the next NPA cycle will start. Right? But I don't see that happening over the next 3 to 5 years. So that's a reasonably safe period if you want to take good credit quality funds. There also you can get some alpha over the bank deposits. Silver is a poor man's gold. So if you are wanting to do that, do an 80-20 between silver, gold and silver within the commodity basket.
So now I'm going to make this a little bit lighter. We've had a full data-driven thing. So I have this Karan Johar type quick fire 10 rapid questions. So
Okay.
it'll be interesting to know your thought process. Don't think, just answer the 10 rapid questions for Sunil Subramaniam. Here it comes. What's your favorite pastime, Sunil? Whenever you have time, if there is a time.
Cricket. Watching cricket.
Watching cricket. Okay. What's the one health fitness regime that you swear by?
15,000 steps a day.
15,000 steps. Wow. Cool. Since you mentioned cricket, need to know which is your favorite team and cricketer at IPL.
CSK and MS Dhoni.
Oh, CSK and MS Dhoni. I know that
But
you do.
I want to add another answer. MS Dhoni is over the last decade, but my childhood favorite has been GR Vishwanath.
Oh, GR Vishwanath. Okay. Okay. Style. Absolutely.
Yes, style over
What's your
substance.
favorite food, Sunil? What's your comfort food?
Rasam rice.
Rasam rice.
Lots of ghee.
Absolutely
That's why I have to walk 15,000 steps to make up.
great. What's the holiday destination that you have dreams to visit, if not already done?
Wildlife. So my dream wildlife destination of Africa, Kenya, and Tanzania I've already done, but there are still innumerable parks in India which I have not yet covered. So it's wildlife is basically a passion.
Super cool. One thing that you wish you had learned when you were younger.
Financial intelligence, financial knowledge. Unfortunately, I learned it very late in life.
You're still
I
young.
think that's one
Sunil.
crying need for our country. I think we don't teach our children enough about, financial literacy is probably the biggest gap in a country that doesn't give social security for its citizens.
Absolutely agree with you. Couldn't agree more. Your favorite actor, artist?
Okay, from history, Dharmender, the Hindi
Okay.
He-Man. Okay, but as an actor, as a star or something, but as an actor, Amir Khan. And close second is our dear Kamal Hassan.
What's the last movie that you saw?
The
You
last
see movie?
I see movies a lot, but since I was not gone to a theater, so the one which now I'm more of a web person. So
Aren't we all?
yeah, so I think the one that impressed me a lot was Family Man,
Family Man. Okay, the series.
the series, and a movie which I was impressed was a Malayalam movie uh, called 12th Man. It's Mohanlal's movie,
Okay,
the most recent, so but I liked it a lot. Very nice.
excellent. Super. Now we know how you unwind. Very good. Uh, Sunil, India at 100, Sensex at question mark. What's your number?
India at 100. 500,000.
500,000. Wow. Just to kind of recap, we are at 62,000 now. Yeah. Okay, super, super. If Sunil was not a mutual fund guy, what would he have been?
Answer is very simple. I would have been a molecular biologist. I actually
Molecular bio.
I actually did a master's in chemistry and I enrolled for a PhD in molecular biology in the University of Science, Bangalore.
Oh, wow.
1.5 years into my PhD program, and that was my passion: chemistry, biochemistry, and molecular biology. I had to drop out because of family situation. And when I dropped out of that, I said, then I changed fields. I joined the bank because that was the easiest exam to write and get into financial services. So chemistry at the bottom line is my passion. Within that, biochemistry and molecular biology came along the way. So I would have, if all things being otherwise equal, I would have been a professor with long hair and riding a scooter to work. And
And a couple of maybe a Nobel Prize added to that. Who knows? Wow. Thank you, Sunil, for that rapid fire 10 questions. Fabulous. Guys, last call for any questions that you may have. If you have, do come out. It's not every day that you get Sunil, who is available to ask questions. He's a jet-setting man, constantly on travel. But I do understand, Sunil, sometimes that the amount that you've spoken is so much to grasp that people are in awe of.
there's a challenge, Babu, because I don't like to just speak without giving the supporting facts. And, but then people get overwhelmed by it, I know. But all I want them to take away is that what I'm talking, the credibility of it is what I'm using the data to say. So
Absolutely.
hopefully, what you remember what I spoke, you're confident that there has been data to back it. You don't need to remember the data, but the takeaway is that there's a logic.
It comes out of the confidence, comes out of the data. Absolutely agree with you. Thank you, Sunil, for sparing time. I think we've been at it for quite some time, but thank you so much for sparing time. I know that you are on a busy schedule. Wishing you the best and look forward to